cooperatives, especially smaller cooperatives, you have multiple owners, and typically if you're doing lending to a small business, there's only a handful of owners. So if you're a traditional bank and you're lending to a business and it's a smaller business on there, especially if it's startup in nature, one of the things that you're going to want is a personal guarantee from any of the owners. You really can't do that with a cooperative because of how many owners you have on there. So that's one thing that makes it different from a banking standpoint, and one thing that the bank has to get comfortable with on there. The other one of the other things that makes a cooperative different is a couple things in their balance sheet. Cooperatives it's all around equity. It's equity in other cooperatives, because a lot of cooperatives will actually work with other cooperatives on there, a regional federated cooperative, whether it's co-bank for them to get their financing, or whether they're getting farm supply inputs from, say, a Land O'Lakes or CHS, or you name it on there. So when they work with those, they get equity back. They get patronage. Typically, part of that patronage is equity, and so they're going to show up a investment in cooperatives in their balance sheet. And so that's not, as a banker, you need to understand that the cooperative has very little control of when they can get access to that equity on there. They're really at the discretion of the federated cooperative, the cooperative they're working with on that. So we just have to understand that that's not something that we could go in there, that we can expect them that they could be able to get their hands on any given time. The other thing is understanding from a net worth standpoint, with the equity that they have on there. They're going to have an allocated equity in addition to retained earnings and common stock on there. And so understand the allocated equity, that is it's patronage that's earmarked for a member, but hasn't been paid out yet. In the long scheme of things, it's it's essentially just retain earnings, but understanding that at some point, as a cooperative, as profits dictate and allow, there is the expectation that will be retired back to the members, and understanding that. And then also just understand the whole factor of patronage on there. And so the expectation is that, that there'll be some benefit, hopefully, back to the members on there in the form of patronage when they have that ability to do it. Well, initially, equity is the initial investment put into the business. It doesn't have to be cash. It can be other goods and such. So if you've got an asset, if you've got a building that you have, or a vehicle that you donate to them, that can be a form of equity that you're putting into them. Over time, you can also have retained earnings on there. So as every year that the cooperative makes money, whatever that they decide not to distribute in patronage or pay in dividends, whatever that's kept in there is retained earnings, and that helps to build a balance sheet, and that can be used to reinvest and to grow the cooperative on there. With debt, debt is going to be something that typically has that always has some type of repayment period in there. There's always the expectation that it's going to be repaid at some point. Might be fairly long down the road. A lot of times the debt comes from banks, but not always. I mean, there's a lot of times where you'll have membership that'll come in, and they'll actually put in we use it as a form of quasi equity. But you might have somebody that's willing to come in and say I'm willing to invest X amount of money in the cooperative. We'll make it so that it is subordinate to the bank debt on there. So from that standpoint, then we look at that as from a quasi equity. But in reality, it's still debt. The member that put the funds in there, or can even be a family member or whatever, that doesn't have to be a member of cooperative, they can, depending on how it's set up, they maybe can still earn some interest, and then at a future date and time, when the cooperative has been able to get on their feet, they're able to repay that debt on there, as long as it doesn't affect the covenants of the loan covenants that they've entered into with the bank on there. So I think you see a lot of startup cooperatives on there, because as we talked about before, the struggle for obtaining debt, they do and tend to go a lot with trying to get debt, again, for family members, from membership on there, where they're all putting some of their own money into it with the expectation of being paid back. But overall, the difference is really patient capital versus, are you looking at getting the money repaid at some point? If you're looking at the money being repaid, there's at some point back to the person who put it in it, that's debt. If it's money that's put into the cooperative as capital to just continue to build the co-op, that's more of an equity. We look very favorably upon sweat equity. So if you have a member that's out there that maybe doesn't have some equity to go in and put some cash in there, but they're willing to really spend a lot of their time, volunteer their time, research things, to do stuff that to get the co-op up and running, depending on whatever you're looking at doing. Maybe they're willing to donate some of their time to, if it's a pooling cooperative where they're all producing, what turnips or whatever it would be. Well, if you get some members that are willing to spend some time to go out there and build relationships with whoever the end user would be there, and are spend that time, we would look very favorably on that. That wouldn't be it wouldn't be equity on the balance sheet, but we would definitely look at that. We call it a mitigant on there. So we would say, okay, the equity might be less than what we're looking for. We're the mitigants. We've got a very engaged, a membership here that are willing to put that time and focus in that, and so that we look at that as being actually a pretty significant key of how well that cooperative is going to do over time. One of the things that we really look fairly upon, and we've done it with the Ohio Cooperative Development Center, and we do it with cooperative development centers at most other states. We work pretty closely with them. One of the things that I would say is, have taken the time, have a well thought out business plan, have thought out what the challenges are going to be, long-term projections on there. And even though we all know projections, once you get past the first year or so, the projections don't hold up. But it's really, really good idea just so you've thought through, what is likely to be in the future. The numbers might not be the same, but what the different growth stages of the co-op or what your co-op are going to have on there. Come up with those ideas. Again, we look favorably if they have worked with the cooperative development centers to fine-tune, to work on their business plan. The majority of the cooperative start deals that we've done have been direct referrals from the various cooperative development centers throughout the country on there. So, so really, what the biggest thing is, if you're looking at a bank to put in, a significant amount of money into your cooperative, we want to make sure that you have put in your time, done your due diligence, and come up with a professional presentation to really sway us and show us, why this cooperative is going to be viable. For most of our cooperatives on there, they kind of look at, it's not so much, as far as how much they pay out there, that's more of a conversation with their tax advisor, trying to look at what they need to invest in their cooperative and what they can lend out, and minimizing their tax obligations. But as far as the composition, that's where we get more in there. So once they paid it out, how much should be cash, how much should be retained equity that gets kept in the business on there, and especially as you're from a growing co-op, from a start co-op, you want to try to retain as much as possible. You also don't want to damage your members where you're paying back more in equity than they're getting in cash, so that they actually have to come out of their pocket to pay the tax bill there. So a nice safe number is usually 30 to 40% of that. It would be cash to kind of offset some of the tax burden for members. Probably, especially the newer one, probably looking at closer to 30%, and then the rest would be retained in there. Once if and when you get the co-op to a point where you built the balance sheet and you've got a really good earnings engine going, I guess I'll say, and you're to the point where you can start revolving some of that equity, that's great. And at that time, you can do that. But initially, I would say you're probably looking at keeping about 60 to 70% of the patches you pay out, keeping that as equity in the company, to be able to continue to invest internally and build the balance sheet of the business. Financial ratios that we look at, which kind of drive our lending decision and drive the pricing for the loan, and it drives how we view the riskiness of the customer. And so we try to be as transparent as possible. We'll show what those four ratios are. We'll show exactly where they are, where they sit in there as far as what we consider to be a strong level, a weak level on there, and answer any questions they would have about that. And then we can also do peer comparison. If there's another, because we lend to so many other cooperatives in there, there's a good chance that we have other cooperatives throughout the country that are doing the same thing that this cooperative is doing, and then we can look at your balance sheet, your earnings, we can compare it to other like type of cooperatives, just to give you an idea of how you compare for that. And and for those peer comparisons, I always like to say it's not necessarily a right or wrong thing, because there's going to be different ways that different co-ops go to market, but it's just an interesting thing to kind of see how other co-ops are doing, and you might see something that the industry as in general is doing that maybe you're not, that you may be able to adopt on there. So, but using those, and those are free on there, but using those outside sources on there to be able to bounce questions off of and get an extra external set of ears, that's one of the things I can't recommend strong enough. And in my experience, that's what all the successful cooperatives are doing.